What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. In today's video, I'm going to tell you about what typically happens in the middle of June, and we're not too far off. Price action has been just in a frustration type of zone here, chopping back and forth. The prior day, we gapped up and then we faded. Today, we gapped down, put out some fear, and then we ripped all the way up to close basically at a high. You can see volume and price action is both contracting here. Price is getting tight, volume is contracting as well. This is all leading up to a very important date. What is that? Well, based off seasonality, in the middle of June to, the ending of June, we typically see some sort of pullback. Why is that? Well, there's something called triple witching that we're going to be discussing today and show you the history of what typically June does during these time frames. Okay, now before we're just talking about triple witching, understand this is the price action of the S&P 500. We've been going sideways and we have a wall of data coming right just in front of us. It's like a car driving into this. Are we going to be breaking to the upside? Are we going to be breaking to the downside? Well, what is all these vertical lines? First and foremost, CPI data. That has a huge impact on the market. Okay, and then shortly thereafter, we have the Fed meeting. That can have a huge impact on the markets, right? We have Fed tightening, we have the Fed raising rates, and then we have VIX expiration, and then we have triple witching. It's all coming up here in June. This week to next week. This is some big stuff that's going to be taking place. If you take a look at the S&P 500 on the daily time frame right now, right, we have been going sideways. The upper risk range is at about 420, and that's still below a declining 50-day moving average. So I want to go ahead and show you now, looking back through history, what typically happens at or around what happens at triple witching shortly thereafter, which is the third Friday into June. So first and foremost, let's look at 2021. So 2021, you can see we started pulling back into the middle of June, but then we started moving higher. 2020, triple witching, right? We started sinking off a little bit there as well. 2019, you can see here coming up from a nice run up, we started sinking shortly after triple witching. So you can see a slow grind lower after triple witching kind of took place. 2018, you can see the grind lower. 2017, you can see the grind lower. 2016, you can see the pretty sharp decline lower. 2015, you can see a grind lower. 2014, you can see a subtle move lower, and then it kind of picked up. And then 2013, you can see we saw that pullback as well. These are the only years that I pulled up. You can keep going back if you'd like, but this is something to note that does match up with seasonality, right? So the middle of June, we have that triple witching. We have all this data coming out. Here on seasonality, based off of a 20-year history, you typically get an undercut of the May low. If that were to actually take place, that'd be a pretty significant hit to the downside, right? So the May low was right here, so that would be a pretty big hit. I'm not forecasting that as of right now, but I will be open to that because we got to look at everything from a risk to reward standpoint. All right, so we have a lot of stuff coming up. Let's take a look here, though, first and foremost at the 15-minute time frame to get a good idea, okay, what can we expect? Well, as we've seen chop, so it's likely to expect more chop, right? And some crazy moves back and forth as we've been seeing. Now, overall, this right here is a bullish consolidation. Why is it a bullish consolidation? Well, we're above a 5-day moving average. It's rather neutral, but we're back above it, okay? And then we can't come in from a strong move to the upside, okay? So that shows a lack of sellers, and it just shows that price is digesting, and typically this resolves to the upside. And if that is the case, right, around 420 to this gap fill, up to 430 is definitely a potential target to keep an eye on. Even a full measured move, by the way, you can take it from this channel, you'd measure, from here, and then you just measure up the same length. That would bring us to right around that range. Okay, now, as it stands right now, we are just in a chop bucket. So we got to be patient. We got to be very good with managing our risk and just be very tactical heading forward. But as it stands right now, it looks like it wants to resolve to the upside, but we're not far away, remember, from all those big data drops, right? The CPI, the Fed meeting, and also the expiration stuff. So we might have a way to drift a little bit higher up into around the 50-day moving average, but just be mindful of all this stuff that's going to be taking place here very soon. If we take a look at the Qs, what is the Qs doing, right? Gap down, recovered quite a bit, finished up on the day. We have upside to around 315, which puts us into prior areas of support. Prior areas of support can become an area of resistance, still below that 50-day declining moving average there too as well. If we look at the 15-minute time frame, we talked about the diamond pattern yesterday. Price is still really contracting, slight breakout, right? We broke down, came right back in with it, kind of chopped around, and now we're starting to break out. A full measured move would take us up to that upper expected move. Look at the 5-day moving average. We're above it. We're just consolidating. This could be drawn out very similar like the SPY. So give it time here. Give it time. If we take a look at the IWM, this one got back above 50-day moving average. So we'll see here if it can build some momentum, right? The upper risk range is not too far off, okay? And that lines up with prior areas of resistance and, of support. And then it now showed as a prior area of resistance. So we'll see here if it can drag a little bit higher or if this is going to be a fake out, right? The rising wedge structure is still in place. You can draw it a few ways, but all you have to notice is price action is getting very tight. You can see we do have a negative divergence, both the RSI and the PMO here too as well. So look at the price action. Everything is contracting right now. It's contracting into some big events that are going to be taking place. So what do you do here? Yes, it looks like it's going to be resolving potentially to the upside, but there are no certainties. So we need to watch for a break to the upside with some supporting volume that could perpetuate us up to around 430. And then that would be a very important level to watch, okay? However, if we start breaking down on increased volume, it can very well take us to around all this previous chart, around 390 to 395. So if we break down, get below 405, look at this. If we break above, start looking for that. Now, it's typically never that easy. I'll tell you, typically we get some weird fake outs sometimes too, so be on guard. It's going to be some wild type of price action. When CPI data comes out, okay, when this drops, you typically, on these big econ drops, you typically get some sort of, rush type move and then it fades or hit down lower and then it rips up higher. So be cautious, let the market digest and take a very nimble approach to these markets. That's all I got for you on today's episode. I'll be back here on Wednesday.